What up, my people? So this is your boy Michael. Let's look at the peacock and the SMC. So this is just the analysis of the market that I'm doing this Saturday to see how the market goes. How do I look at the market? What are those points that I look into the market whenever I look at gold chart? You see, I think gold has been on its all-time highs. Price has been moving higher since it crossed the mark of 2500. 2500 was crossed somewhere. Let's just put a mark on 2500 where 2500 was crossed. I'll just do that. Set it to 2500. And ever since until now, I haven't yet gotten a reason to sell gold. You can only sell something if it's giving you a reason to sell, or if it's invalidating any highs to the lower side. So to this moment, I still are looking for gold buys, and gold has been having the quite cleanest charts every time it trends. You see, from this mark, this is where the 1500, 2500 mark was crossed. And you see a fair value. There's something that you need to note from how gold is behaving. There's this fair value gap here that was left. What did the market do? Come, failed to close below it. Did what? Went ahead. It can test this fair value gap so many times, and that's not the problem. You see, you trade what you see, not what you feel, not how you want it. Let the market, let the big money show you where to go, how to do about it, and you just follow. You see, all this was just entries to take the market up. You could say the market went ahead to close above 2500, right? Then traded back to the fair value gap that was left, which brought the price somewhere below here, but it did not close below what? This low here, which was like the more important low for, it's more like the low to beat for you to bring price where? Price downwards, but it didn't, right? So it continued to rise higher, going ahead to break a short-term high here. This short-term high here, you see this short-term high? This short-term high here was broken after a consolidation. This market consolidated. I know this is where people tend to just force things. You see here, you tend to force things because the market did a big range between the high till when it returned back. The whole of this region, okay, the whole of this region became a range. Let's say the whole of that. That was a whole range of how many days? After this high, that's 1, 2, 3 came. You might actually made something maybe after this rejection on the following day. And then that is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 16 days of consolidation. You see, this is where now you lose your money. Why? Because you want to force the market to give you something. What do? I only trade when I see a fair value gap has been broken. That way, it can actually give me the direction of where the market is going. So this was a consolidation. I'm sure I should have been trading maybe something else during that time. But this here is where people lose money because you don't know where the direction of the market is going, but you're trying to force things. So after that, a key level of 2530 was broken. This one here, right? What the market did, it did the same thing again. It left a fair value gap. Let me just mark that again. Let me mark that again. Let me try to make this a little lighter. Okay, that was the range. Another fair value gap, price here, that was a high, right? That was the low, okay? So this is how I trade, or this is how I look at the market per se, just to see where the direction of the market is going. That could not be the entries, but of course where the market is going and how I get to know where my bias is actually going. So let me just continue using that one. So I try to find, for example, the 50% or the upper side of that uh, that that range. This range, this is the 50% of it, right? This range has a 50%, the middle border, a little bit stronger, like that. So this middle border, what I want is, I want to see price, I want to see some sensitivity of price on the upper side, right? On the upper side of the market. It might not just reach 50, but just the upper side of what? Of that side, of that range, of that fair value gap. I want to see that upper side of that fair value gap trying to be sensitive, trying to be sensitive, trying to be sensitive. Let me give it a different color. Sorry if I'm taking a lot of time, but that is the range that I want. That is the area I want market to be sensitive to take the price higher. What happened? You see, this one here, this is where the price was, right? When the price closed to be above this one, I expected the next candle to be bullish more, so as to leave a fair value gap here. In most cases, it's like when you say break and retest. So this was a region. The high, that was a region that had resisted market to go up. So when it was broken, okay, a small retest, the market should be bullish. So a fair value gap was less. This was more of automatic. So, but then this fair value gap here would let me know that the market is going to come down. The best buyers would be happening below here, when this fair value gap would be rejected. So when the moment price came to this region of 50%, right? Actually, this region, the upper side should be sensitive. When it came, even if it didn't reach this line, most cases it does, but if it didn't, still the same, it's okay. This day when it closed, you knew it has become bullish because it has closed above the entire fair value gap and the 50% of that side. So the following day, you only target the midpoint of the week. Remember this, if this is going to remain as a fair value, if this one is going to remain as the low, a short-term low, this one here, if it's going to remain as a short-term low, which it does, the 50% of it must be sensitive. You see this week here. So, you see this week here. This week, the 50% of that week should be what? Should be sensitive. You see, that 50% of that week, this was the fair value gap, right? This was the fair value gap. We're looking at the 50% of that fair value gap, 50% the upper side, okay? We got that, the candle rejected, but now we have the week, the short-term shadow of that week, right? The tail, what we call the tail, here's a week. The next day, the 50% of that week should be sensitive for the buys. And that's what happened. The market came, could be maybe the London session or something, came, got sensitive. This is where I get my entries from, people, blah, blah, fair value gap, and those so on and so on. This area here should give me a signature of a bullish market. I'll try as much as I can to get my buys here, to take them to the high of this region. Whether I take it here, whether I only get what I get, but during that day, the entire day, I'll be looking for patterns that will give me a buy to that side. That was clean, right? Now, the next short-term high was the high that had been created by this candle. Simple. What again? I wait the market to do what? To clear that short-term high. And it's here. It's here, right? It's here. The market has done what? The market has cleared that short-term high again, leaving a fair value gap. We come back again. Fair value gap here, okay? But what do you know? The market is bullish. The market is bullish, purely bullish. Whatever is happening, you are now getting the market to give you a bullish a bullish momentum. So what did the market do? The market came here. The market came here, cleared this fair value gap, cleared this region here, went higher, left. What did I say again? Once the market pushes this, the next day for me should at least leave a fair value gap here. So that day should be bullish. What do I do again? As I eat this one, I continue to make sure the following day I also scalp for buys. If buys are there, good for me. Setups for entries of buys, of course, you should be having the easiest way to do for a lower time frame entries for buy. As long as you already gotten the buyers, it's a buy. What did the market do? Went like that, left what? Left a wick here. So the following day for me is the day that I either wait for a return to the fair value gap or a continuation upwards, which the market did. What did the market do? So you see, this day, what remained above here would be a high, right? I want you to be careful, to be seeing these highs that I'm drawing. Another short-term high has been created above there. It's like the current high. What is the high right now? Okay, don't mind my drawings. So that is the high. So I expected the market to do two things. For it to come to this fair value gap, this day could be the data day. The market needed to do what? To come lower. But it didn't. It didn't come lower, came to the body and went bullish. And by the way, when it went bullish, it did what? It broke this high so strongly that this day went so bullish. My expectation then would be this next day would not be a very active day, should leave what? Some fair value gap here. The moment the market leaves this fair value gap here with this candle, the upper wick of that candle becomes my wick of trading. So that if the market is going to push higher and leave this region, 50% of it being violated, the next thing would be, where should I get my best buys? My best buys should come from the fair value gaps that have been left here. I might not have gotten a chance to use this one here because there was no good setup, but look at this one here. Now, this one here, every time the market would try to come down, my highs would be looking at the market trying to reach where? Reach this fair value gap. As long as the market does not do two things. One, close below the wick of this candle here, which would be my current, that was then the current short term. Then, between this candle and this candle. So then, you would see the candle does what? Came all the way to the 50% of the fair value gap. The one I said again, it became sensitive. In fact, this time around, came almost to the peak on the 50% and went higher. So Friday is closed as it is right now. Now, two things are going to happen again. We have the wick of this candle, which is the short-term wick. We have the wick again of this buy candle here, right? So these are the two regions. This is where now the decision happened. Is it going to be bullish? Is it going to be bearish? But what are we seeing? We're only seeing this market is going to be bullish. In any case, the market decides to come down. My only hope is to see it come down to the 50% of this region, right? Of this region, gold sensitive, to take the market why? Take the market up. That's what I expect. I only expect the market, if it only comes down here, to be sensitive here, to go up. So that's what is going to happen. But then I'm still looking at the market that is trying to, that has left a fair value gap, that has gotten sensitive to that fair value gap, and is still bullish. Real signs for bearish? Not yet. Not yet. Unless the market comes close below the wick of this, 50% of the wick of this low, come all the way to close below this fair value gap. And then my highs would be return to that fair value gap, and the market should come where? Should come down there. As it is, we're bullish on gold. We're bullish on gold. The only region we'll be looking is a dip to this 50%, then we take gold higher. If it doesn't do that, then we're going to see just a burst of this region here, above, close above it, return to it, you continue taking gold higher, because gold has not given us a sign to be bearish yet. So that's how I look at it. Next time I'll be showing them how do I enter those sniper entries, combining smart money with my PPOC strategy indicators to nail the market in the right time, under 15 minutes time frame. Thank you.